Hi, I'm Guy Myles, founder and CEO here at Flying Colours. Our videos discuss themes that matter to you when investing your money. Today I will be talking about what's been happening in markets during the first quarter of 2025. In short, it was all about reacting to and then anticipating what Trump would do next. We now know there is a baseline of 10% tariffs across the board for any country, even if that country runs a trade deficit with the US, as does the UK. We also know that while some countries have been slapped with extra tariffs, such as 20% for the European Union and 25% for Japan, these have been put on hold for 90 days pending negotiations with Donald Trump himself. China faces even larger tariffs, leading to what can now be described as a full-blown trade war, with tariffs currently at 145% in the escalating conflict between the two largest economies in the world. The impact of Donald Trump's policies, whether in trade wars or general geopolitics, has created uncertainty in the real economy. This has led to more cautious spending, particularly in the field of AI, which is expected to be more modest now than initially anticipated. This presents additional challenges for AI companies that were already unsettled by the launch of DeepSeek earlier this year and the broader Chinese advancements in the sector. Questions have been raised about the sustainability of AI investments. This chart shows how one stock, Nvidia, has fared over the past year. Take a look at how it peaked in January and has since lost just under 30% of its value, despite having returned 1,500% over the past 5 years. More generally, investors have favoured non-US assets over the quarter. Have a look at this chart. You can see that in Europe, the price-to-earnings ratio, which is a good way to measure value, is considerably lower than elsewhere. An average PE ratio lies in the region of 20 to 25 times. The FTSE 100 index returned 6.1% for the quarter, and the FTSE All-Share posted 4.5%. European markets had their best quarter since 2022, with the MSCI Europe, excluding the UK, up by 6.3%. Germany also contributed to Europe's numbers, with its government committing to increased defence spending, plus a stimulus package worth 500 billion euros, along with a manageable inflation rate of only 2.2%. Bond markets generally benefited from the environment because concerns about the economy generally help bonds. When growth is down, yields drop, which means that bond prices increase. At quarter end, the US 10-year Treasury yield had dropped to 4.2% from 4.6% at the beginning of the year. Have a look at the chart showing US bond prices, the index, and their relationship to yields. Elsewhere, the news was not as good. Japan, a net exporter to the US with its large car industry, saw its manufacturing Tankan index, which is a reliable measure of confidence, down to 12 in this quarter from 14 in the previous quarter. In addition, Asia and emerging markets also had a disappointing quarter. DeepSeek and China excitement aside, the MSCI AC Asia was down by 1.1%. In summary, sentiment has flipped from being positive at the start of the quarter to negative by the end. There is still some way to go before the outcome of Trump's actions are known and for markets to price in the consequences. If you have any questions about today's video, please get in touch. Just email hello@fcadvice.co.uk. Finally, as ever, I've been talking about investing, which means your capital is at risk. And thank you for watching.